So today's webinar is the last in our series and is aimed at livestock operations. So today, and I want to make sure we get our slide up. There we go. Okay, good. Today we are going to hear from two experts on whole farm revenue protection. Scott Marlow is the Executive Director of Rural Advancement Foundation International, which is a North Carolina-based nonprofit organization. And Clif Parker previously served in USDA's Risk Management Agency, which is, as you all know, this is like in my script, but you know this already, obviously RMA administers crop insurance. And Clif previously served as the Assistant Deputy Administrator for Insurance Services. Clif works as an independent risk management consultant. So, yeah, we have an hour, and Scott and Clif are going to each present, and then we'll have some time for questions at the end. And so before I kick it off, I want to share with you a couple of logistical things. So first, in your webinar program that you logged on through, there's a box for questions, and at any time during the webinar, if you're confused about something or wondering how what you're hearing about might apply to your operation, feel free to type in a question in that box, and we'll see it and we'll address it. So don't be shy. And then also the other logistical thing is that we're recording today's webinar, and we will post it later on YouTube and send around the link. So, so if you want to go back and review it, that will be available. So with that, I'm going to hand it over to Scott.
Thanks very much, Anna. Let's we're just shifting over the screens here quickly. There we go. And thank you very much. As Anna said, my name is Scott Marlow. I'm the Executive Director of the Rural Advancement Foundation International, USA. We're based in North Carolina, but not dissimilar to the Center for Rural Affairs. We also work nationally and also internationally. We've been working on whole farm revenue crop insurance for quite a while, back from when it was adjusted gross revenue light a few years ago. Some of you will probably remember that. And so we're very glad to be a part of this webinar and be a part of getting information out about whole farm revenue. So why is this important? So first of all, and I don't know that I'm saying anything, and bear with me. I'm going to sort of give some overview and background information that we thought was important, and then Clif is going to dive into some of the real nitty-gritty on the policy. Crop insurance is the primary government program for addressing production losses in agriculture, and that's been a very clear message from Congress over time, where they are really not doing the kind of ad hoc disaster programs that they used to do to address production losses. It's really assumed to be taken care of in crop insurance. So for people who do not have effective crop insurance, that sort of leaves them out on the disaster safety net. But we also see that crop insurance is important long before the disaster happens, because it's really integrated into how lending decisions are made and how an operating loan especially is collateralized. And so crop insurance has real important implications for an operation long before they hit the inclement weather or difficulty in production or prices. And as we sort of know, as we all know, we're facing some really different climate patterns, and an increasing number of the severity and the numbers of storms. And so having good risk management programs is very important for operators at this point. So also, crop insurance has very well served a lot of the commodities like corn and soy or cotton in our area. And that's probably the crop insurance that most people are really familiar with. There are policies for a series of specialty crops, but specialty crops and especially specialty markets are not well served under the existing programs. Livestock is also one of those areas that is not well served under existing crop insurance and disaster programs. And also there may be uninsured income from other on-farm enterprises. And so the whole farm revenue is a way to capture all of that value. It also provides a new market for crop insurance agents. It's serving the growing market for higher value specialty products. That includes meats, that also includes specialty crops, direct markets, direct to restaurant, all kinds of markets like that. And it's an opportunity for agents to differentiate in the market, in their marketplace, by understanding how this policy is administered. It's a, the use of this policy has been very limited geographically and in the and in the types of farms that have used it. Cliff and I both agree that there is much wider opportunity for use of this policy, that there are much wider uses than are currently being done, and we see this as really a market gap and an opportunity for agents to step into a growing and emerging market. So whole farm revenue does several things. First of all, there are several aspects about whole farm revenue that are very important. One is it incentivizes diversification. This is a diversification, obviously, is an important risk mitigation strategy, and whole farm revenue actually gives you a better deal the more diverse your farm is. It can recognize a proven farmer's price. So if a farmer is selling into higher value markets for meats or vegetables or corn or soy or whatever they're selling, they can get coverage under this program for that higher price that they are able to get. As I said before, it allows insurance for products that were previously uninsurable. So basically everything that is produced on the farm can get captured under this type of crop insurance. And the insurance for livestock is allowable up to $1 million in income. So it's there's a significant level of coverage there for livestock. So y'all probably know already, and I'm probably not adding to the knowledge, but just, y'all know that there are a couple of existing livestock policies, the livestock gross margin policy, the livestock risk protection policy. That's cattle. The livestock gross margin is cattle, dairy, or swine. The livestock risk protection is cattle, lambs, or swine. A couple of things about that. One is that they're based on the Chicago Mercantile Exchange prices, so that doesn't have any recognition of prices other than that level. And they're available only in limited states, so it's not completely available across the country. That's heavily in the Midwest and Upper Midwest and some of the mountain states. So whole farm revenue, how does this work? And from the big picture, it ensures the revenue from the whole farm operation as it's determined by the 5-year average on the Schedule F that's filed in the person or the farm's taxes. If a person is a beginning farmer who has farmed for fewer than those 5 years, it can be as few as 3 years, but only if they're within that window. Once you get past the 3-year window, you have to use all of those years. The loss is determined by the Schedule F from the insured year. So, for instance, if I had a policy for 2016, my loss would I would only be able to file a claim on the loss once I file my taxes next winter, or this coming winter. So the payment comes only after you filed the Schedule F for that following winter or spring. And the rate of coverage is up to 85% of that 5-year average. And I think it's worth talking a little bit about whole farm versus multi-peril. When is which one more appropriate? Whole farm is very good for diverse operations who have some income from products that are valued at other than the wholesale conventional price. And like we said before, it covers crops that don't have specific crop insurance policies, so it can capture, so that kind of diversification can be captured here. When it's available, because of the risk analysis, the multi-peril crop insurance policy is going to be generally more cost-effective for, things like corn or soy or cotton or things like that because of the way the data works. But those multi-peril policies can be nested within whole farm revenue, with whole farm ensuring the gap between what's covered in the multi-peril and the gross income. So if a farmer produces a range of commodity crops or or livestock, or is selling into higher value markets, is selling meats or something like that, it's significant income, and they can get multi-peril for part of the income and cover the rest with their whole farm revenue. So let's say how this works. Let's say Anna is producing $100,000 each of corn and soy, has $50,000 from direct market grass-fed beef, and $50K from a specialty wheat, for a local miller. That makes the average revenue of $300,000. With the diversification coverage at the 85% level, 85% of $300,000 is $255,000. So that's the indemnity level. If she takes out crop insurance on the corn and the soy, any payments from those policies become part of the income that counts against that income. So let's say she loses half the income on the beef and half on the wheat. Her remaining income is $250,000 and the indemnity is $255,000. So the check she would get is $5,000. But if she makes an extra $20,000 on each on the corn and soy, then that total income then is above the threshold and she doesn't receive a payment. So this is one of the important concepts about how whole farm revenue works, is that an increase in income from one crop offsets the loss in the other. That's the whole farm part here. So there are a couple of important considerations as we go through this. One is that the application process can be somewhat complicated, so it's important to get started as early as possible. So if there's someone that you work with who you think this would be appropriate for, getting them started in the process early on is a good thing. It covers the minimal processing needed to bring a crop to market, like putting it in a box or a crate or whatever, but it doesn't cover the processing that adds value. And the other part of it is that 5-year average, there are several ways that there's a growth factor. If you've shown growth over time, you can increase that based on your growth over time. But it's really important to understand how those growth factors work, because if you grow past that point, all of that income still counts, and it can effectively reduce the coverage level. It's very important when working with someone on this, because it's a little bit different from what people might be familiar with in terms of crop insurance. We really encourage folks to walk through the scenarios. So for the cost, what are you getting, and what are the situations in which, if you lost X amount or that amount or whatever, and just, this is something that agents do all the time, but really to walk through those cost and value and anticipated income or anticipated payment scenarios, just to make sure that people know what they're purchasing before they get there. Sorry about that. And so that's where I'm going to stop. I think I'm going to stop and let Clif take over and go more deeply into the policy and go more deeply and to be able to just to give you more of the nuts and bolts.
Great. Thank you so much, Scott. It was really a great overview. Clif,
Okay.
Great.
All right, you ready for me?
We are. Go for it.
Okay. That was a good overview from Scott there, and I'm going to add a few things, but I think Scott did a really good job on the overview. Give you a little of my background. I grew up on a farm where we grew everything: cattle, hogs, chickens. We had a few layer hens where we sold eggs, but we were a tobacco, corn, soybean farm primarily. And so I really learned the advantage of diversity on a farm when I was young, that have a major loss on one crop and the other crop you do pretty good on. Then I went off school at North Carolina State University, where I graduated in agriculture, and then worked with USDA for 30 plus years and retired as Assistant Deputy Administrator up in D.C., which I was in charge of all the field offices was my primary job. What I'm going to talk about, what this whole farm, I'm going to give you an idea from an agent's perspective, because yes, I work for a consultant for an agency in North Carolina where we do have probably around 13 to 15 whole farm policies. So I know from an agent's perspective the hurdles you have to overcome to sell whole farm. But there's one thing to keep in mind. As an agent, this is a whole new market that we can tap. What has happened through the years, and I saw this a lot when I was with crop insurance, is we trade in business around and around between companies, between agents. We do a lot of trading business is all we're doing, not picking up new business. Well, there's some really good markets not tapped out here, livestock and markets for commodity crops and for all you specialty crops are not currently covered. So whole farm covers everything, including animals, animal products, commodities purchased for resale up to 50%. Only thing it excludes is timber, forestry products, and sport, show, pets and stuff, because we're talking production agriculture here. And the thing is, even crops like there's some crops out there that they like tobacco that have an MPCI program, but there's no replant on them. This covers replants on a lot of those crops that wouldn't have replant coverage. Coverage levels all the way up to 85%. There is no CAT on this, so the catastrophic level, which most agents won't be really unhappy about that, because as we know, CAT is just what it is. It's catastrophic losses, which a lot of times when you sell catastrophic level coverage, once somebody has a loss, they're very disappointed because of the low level of coverage. When you combine the 50% level coverage with the 55% price, you're down to a very, very low level coverage. So this starts at 50. Most people buy it to 75% level. I would say 85 to 90% of the people buy whole farm buy it to 75, and you'll see why in just a minute. So it's in 5% increments, just like most of our crop insurance. Historic revenue is adjusted to reflect farm expansion. That's something that Rafi, which Scott Marlow is the director, and I work with them. We work with RMA, and we push real hard to get 2 new changes. One was what Scott talked about a little while ago. You can go with 3 years now, 15, 14, and 13 for new beginning farmers. And another thing is growth. If you're growing, which a lot of our small farmers are growing, vegetable crops and things like that, you can have up to 35% growth, which is very good. That's a new addition, just started for 2016 crop year. What are the features of whole farm? Cost for market readiness operations may be left in the approved revenue on this new product, but no added value. If you're selling cattle prices, but if you're grinding hamburger selling it, that's not included. The cattle price, yes, to get the cattle to market, but not what we call added value. You're growing grapes, they're covered, but the wine, that part's not covered. The making of the wine and the cost for that. And you do combine this. This question comes up all the time. I've got a producer, he's got corn, soybeans, he's got some cattle, he's got some watermelons, some cantaloupes and tomatoes. So he's covering his corn and soybeans now. Yes, that's a good risk management strategy. You may want to cover some of those commodities under your whole farm. And if you do, what happens as an agent, it's a real good sales tool, is sell them this whole farm over the whole crop insurance, over their whole operation. And then if they got specific crops they want to cover under it, they can cover those. That liability comes off the liability for whole farm for premium purposes, not for guarantee purposes, but for premium purposes. The whole point is we're not going to double cover them. We're not going to charge them double for the coverage. They're paying for it here, so we're taking it off. So what you do is you take it, the liability is $100,000 on the whole farm. The liability on the corn policy is $20,000. They only pay premium on $80,000. And but they still got $100,000 coverage. So that's a real good sales tool. And just remember, you can't have CAT under that. It's got to be buyout coverage. All farm revenue is insured under one policy, so individual commodity losses are not considered. What that means is you got cattle, corn, soybeans, and wheat. You could have a severe wheat loss, but your cattle prices go up. You have a good corn crop, so it's overall, it's over your whole operation. Premium subsidy, really, really important. I'm going to go to the next slide because I've got agents on here and you understand this really well. Let me, if you'll look at the 75% level, that's where most people fall at, and you'll see why most people buy there. You know, you can sell this product to somebody with one commodity, but it's not as attractive to a person with one commodity because, as you can see, it's got the same basic subsidy that most of our crop insurance programs have, 55%. But if you go to 2 commodities, you get the whole farm, or you get what we consider our enterprise unit discount subsidy. It's 80%. So at a 75% level, you can get 80% subsidy. That is very attractive and a very good sales tool when you go out and talk with farmers. Now, you've got to have at least 3 commodities to qualify for the 80 and 85% level. Yeah, I do have some policyholders that are at the 70, at the 80%. I don't know of any at the 85. I'm sure there is, but I do have some at the 80. As you see, the subsidy is still 71%. Now it drops down to 56, which is still good subsidy. But as you can see, it's real attractive at the 75% level. Okay, another good thing is I don't have to worry about looking at actuarial tables to see where I can sell this product. You can sell it anywhere you're writing business in the whole United States of America. You can sell it and that's one of the first products that's like that. As with everything, there's a few exclusions. The exclusions are if you got somebody that's over 17 million is their expected revenue, they will be excluded because you got to have at least a 50% level coverage, and that'd be 8.5 million, and that maxes out the revenue of this product. Livestock. We're primarily hitting on this one for livestock, people that are selling and working with livestock producers, and what that is, that's $1 million. If you got over $1 million animal and animal products, you're excluded from this product. You're not eligible. Or if you have over $1 million greenhouse or nursery. Now, with the nursery, keep in mind, floriculture is not covered. So if you got people that's got cut flowers, they can be over $1 million. That we have that situations like that. That's just nursery. That's commodities that can be covered under our nursery policy. What kind of farms can benefit? Diverse farms are the most benefit to this because of the subsidy and other factors I'm going to talk about in just a minute. But farms with specialty commodities that can't readily buy insurance, that's a good one for them. But it's good for anybody. I like a mix of, got a lot of clients that's got a mix of livestock, got a few row crops, and then they got, say, watermelons, the cantaloupes, or sweet potatoes. So those are the farms that really works the best for, but this product will work for anybody because it is revenue, and that's what we're all striving for, whether we're selling crop insurance, whether we're farming, whether we're running a store. It's all about how much revenue can we produce from that product we're selling or raising. Available to all farms or ranches that qualify, and like I said, there's some qualifications. We're going through them. The whole farm insured revenue is the lower of your current year's expected revenue. So if the expected revenue is $1 million, let's say, based on the current price, based on your average yield or the county yield, if they don't have an average yield, they're new, we come up with their current year's expected. So on sales closing date, what do you expect to bring in that year? That's what we're arriving at. Then we look at your 5-year history, unless you're a new producer and you can get by with the new changes with 3 years, 15, 14, and 13. But as a rule, it's 5 years. It's 15, 14, 13, 12, and 11. You divide those 5 years, Schedule F, that's gross now. You come up with what they have, and let's say they take a 75% level. We just got to make sure you can produce enough to satisfy that 5-year average, because USDA is not going to insure someone for more than they actually plan to bring in. Okay, the number of commodities produced is really important. Super important, because all the way up to 7 commodities, it gets cheaper and cheaper. So the premium rate goes down all the time. 2 products cheaper 1, 3's cheaper 2, all the way up to 7. It caps out at 7. Okay. Diversification measure determines eligibility for whole farm. Potato farms. If you've got a farmer that has only potatoes, they cannot buy this product. That's a rule that was put in place way back. The National Potato Council did not want commodity insurance on potatoes for revenue coverage because they thought it may flood the market. So now, if you got a potato farm that also has cattle, yes, they can insure. Or if you got one that's got one other commodity, whatever. Commodities insurable with other revenue coverage must have 2 commodities. What that's saying is if you've got somebody that produces corn, there is a revenue product on corn, so they would not qualify for whole farm. But if they grow corn and soybeans, yes, they would. Okay. And the 80 and 85% level, you must have 3 commodities. Diversification measure also determines the amount of diversification discount to the premium rate. Like I said, all the way up to 7 crops. And you know about the subsidy. You get the premium subsidy, the 80% if you got 2 or more commodities. Whole farm covers revenue produced in the insurance year. A commodity not harvested or sold will count as revenue. So what happens if you got a commodity out there and you don't harvest it, but you go and harvest it later in the year? Say you planted that you were supposed to harvest this year, but for some reason you didn't get it harvested, that counts. And the way we do that is we have inventory and accounts receivable. Inventory is anything you have on hand. Corn in a bin, sweet potatoes in a bin. Accounts receivable is anything you've sold but they haven't paid you yet. What we do is we try to attribute that to the year. It was actually attributed to the year that it was grown. Now for livestock, as an example, calves worth $800 at the beginning of the year, and to be sold at $2,000, the value of the insurer will be $1,200. So what we try to do for livestock is what it's going to be sold for that year. We're engineering revenue, so your breeder cows and stuff like that wouldn't be included. It's just whatever you plan to sell that year. Now, if you get to the end of the year and you don't sell it, we've got to come up with a value for it. So what will happen with livestock a lot of times, you're planning to sell 1,000 head in November. The price drops to 50 cents a pound. You say, oh my God, I'm going to hold them a little longer. On January 31st, if that's the end of your calendar year and end of your tax year, then we've got to appraise those cows. What we would do is take the price that we can come up with, your local price based on your price on the Chicago Board of Trade or whatever the local market price is, and we would apply that to the pounds of cow you got to see what the value of those cows are at on the field that day at the end of the insurance period. That's what will be counted as your inventory, and that's what will be counted as what we call revenue to count. And back in old terms, we would call that production to count, you know, for you agents who've been around a while. So we call this revenue to count. Prices used to value commodities to be grown must meet the expected value guidelines in the policy. So you have to, what you're trying to determine is exactly what you're trying to determine. What you're trying to determine is what the price is for that commodity, for that producer. That's what we're trying to arrive at. Okay, what's the cause of loss payment under whole farm? Natural causes of loss and decline in market price during the insurance year. So anything, if you look at our MPCI and you put that whole list of causes of loss, all of those are covered under whole farm. Drought, volcano, hurricane, you just keep on. Then you add market price decline. There's one other little kicker in this policy that I really like, and it's a real good reason for farmers to look at it. Let's say you got a farmer with cantaloupes, watermelons, tomatoes, anything. The price drops and you can't afford to harvest it. You've got a crop out there, but it drops to 2 cents a pound for watermelons. You can't harvest them. We'll appraise them. If you take NAP, which is the non-insured disaster assistance, FSA, or you take federal crop on any of the other crops, if the product's out there, we go out, we send an appraiser out, a loss adjuster, they appraise the crop, and that production counts against you as production to count just like you harvest it. Not with this product. With this product, if you cannot afford to harvest it because it costs more to harvest than it's worth, it don't count against you at all. The loss adjuster comes, looks at it, and it's written off. Probably one of the biggest downfalls, if there is one with this policy, is farmers want their money as soon as they can get it. With this, you've got to file next year's insurance. You've got to file next year's insurance before, next year's taxes. You've got to file your taxes. Now, the IRS will probably like this product because it will sort of force farmers to go ahead and do their taxes earlier. So if you've got a loss this year, you want to do your taxes as soon as possible for 16, because as soon as your taxes are completed, then you can finalize your claim for whole farm. So last year there was a couple of losses that I know of, some farmers I work with, so they did their taxes in February. They said normally they even asked for an extension, but this year they said, hey, I got to get my taxes done so I can get my indemnity. Okay, as an agent, there is some work to do with this thing. It's not, and it takes a little learning curve, but it's not that hard to do. One thing you've got to do is get 5 years of the Schedule F. That's the basis. You've got to get 5 years of Schedule F. If they don't have a Schedule F, you can get a supplemental Schedule F. There's one, your company, whoever you're writing for, you can probably go to their database, their website, and pull it off. So you've got to record those 5 years. So that's first and foremost. And unless they're a new and beginning farmer and they only have 15, 14, and 13, then you can use those 3 years now. So the very least is 15, 14, 13. If they farm 5 years or more, though, you've got to have 15, 14, 13, 12, and 11. Okay, that's the first thing you got to have. Then what you've got to do, you've got to complete an intended farm operation report. That's where it gets a little more complex. It's not hard to get a Schedule F because most farmers have accountants. They can email them to you. I always tell the farmer, call your accountant and tell your accountant I'm going to be contacting them because you're going to have questions. There's very few Schedule Fs you're going to pick up. A lot of them down at the bottom will have see Exhibit 1, Exhibit 2, things like that. You need to know what that is because there's specific expenses that are allowable. And then, so you'll want to know what those expenses are exactly, because some people will put labor under Exhibit 1. They'll put subscriptions under it, which is not, which is not allowable. They may put crop insurance premium under there. That is allowable. There's things on allowable expenses and under allowable income that you want to know about. So it's good to have a relationship with the accountant of the producer. So what you do is I tell the producer, tell your accountant that I'm going to be calling them and to let me talk about your business with them. Give me the authority to do that. Once you obtain their respect or their credibility, that will not be an issue. Then what you have to do is intended farm operation report. That's not hard. The first part is not, because you ask how many acres you plan to plant next year. The guy says 10 acres of tomatoes. Okay, that's easy. Now what you got to do is get their past history of growing tomatoes and see what their APH is. And y'all know what that is if you're agents, the actual production history in the crop. Or if you can't get that, you've got to determine what the average is for that county. So sometimes I get with FSA and get the NAP, because they've got almost every crop outlined. And so for that state, if tomatoes average is 400 boxes, then I will try. Then you've got to determine what the price should be for that. What is the intended price, or what do you think the price is going to be for that commodity that year? If the farmer's got records of a contract, or if they have records, past history of selling the product, then we use that. If not, then I use NAP, I use NAS, I use the marketing news. What you're trying to get at is how many acres he plans to plant, he or she, and how much production is going to be there, and what is that production going to sell for. So January 31st, February 28th, March 15th, whatever the sales closing date is, you want a snapshot of what that farmer expects under a normal crop to bring in that year. Okay, that's what the whole basis is. And then you need other things. If they're organic, you need to get the organic certification, inventory or accounts receivable. You need all that information for carryover and things like that. As you see here, the first thing you have to do is with MPCI, you got an intended acres, acreage report, and production report. Under whole farm, you got an intended farm operation report, a revised farm operation report, which is usually in July. Intended's in for sales closing, then you got to revise, then you got to do a final at the end of the year. So you're going to have to make contact with that farmer at least 3 times. Before sales closing, middle of the year, and at the end before sales closing the next year. You're going to be talking with them anyway about their intended for the next year, so you do that closing out at the same time you meet with them for the next year. So it's 3 times you're going to meet with them every year here if you've got a whole farm policy with the producer. Sales begin upon release of actuarial material, which right now you sell the product. I suggest you get out and work with farmers right now, because you've got to have all your paperwork done by sales closing, which is specific these dates, county specific, January 31st, February 28th. So all of this stuff's got to be completed by then. But another good sales tool with this, the farmers do not have to pay their premium to August 15th, which hopefully they've sold some of their products, and then they get 30 days without interest. And then, as with everything, though, it's very critical they pay by the next sales closing or cancellation date. Don't they lose their insurance and all their USDA benefits? We don't want that to happen. And if you do not, keep in mind with this, as agents, if you do not work with that farmer to get their completed end of the year farm final operation report, they're limited to 65% coverage for the next year. We don't let that happen. As agents, you know where this is at, and you don't need to know about where other agents is at, but this is something we always tell our farmers is where to go out and find our agent force at, and then always go to FSA if they can't find an agent or they don't have a computer, go into FSA and find one. Okay, Anna, I think that gives us a very good overview of the whole farm policy, and I guess now I'll turn it back over to you for questions.
Yeah, thank you so much, Cliff. That was really a great overview, and there's a lot of detail in here, but you covered it really well. So thank you again. Yeah, so I've got some questions for both of you. I was hoping maybe both of you could speak on this question, which is that this crop insurance policy, is a new policy, and it represents a business opportunity for crop insurance agents. And I was wondering, I know Scott mentioned it briefly, but who are the livestock producers that are going to be able to take advantage of this program, and who are going to be maybe new crop insurance customers because it exists?
Oh, just a minute. Let me get this. Anna,
did you hear that?
I did not catch that. Can you just ask that question again? I did not catch that. I apologize.
Totally okay. Yeah. The question is about what producers are potential new crop insurance customers because this product exists, and
okay.
Yeah.
I tell you where I really centered on. I have started looking at people that are growing commodities like all of your specialty crops that the only thing they could buy was NAP coverage. Another one is livestock producers that maybe, I'm not sure you're going to go out and really market strictly just somebody with cattle, but let's say a lot of these people that grow cattle also have pumpkins. I know I'm seeing in a lot of areas of the country, a lot of the cattle people will supplement their income with like pumpkins, watermelon, sweet corn. These are people that they can get 80% subsidy now because they got livestock, and they've also got they've got pumpkins or whatever else. The only thing they could buy was NAP, and as we know, NAP is limited to $125,000 per entity. So you've got a whole new. I would say out of my customers, the agent that I consult with, I would say that out of his customers, 90% of them did not have crop insurance before. And this new tool allowed them to go out and actually have good risk management coverage. So that's the new, yeah. So those are the people I think you can reach.
Awesome. Scott, do you have anything else to add to that?
Yeah, I guess what I would add is, one of the interesting things to look at is if a person, just to look at the total coverage that a person has in their crop insurance and the difference between that total coverage and the gross farm income on their Schedule F. And the broader that difference is, more likely they are to benefit from something like this, because that's obviously, they've got uncovered income. And one of the things that I don't think we talked about earlier, but is true for livestock, is that under production contracts where the farmer does not own the product, so that's largely poultry and hog operations, confinement poultry and hog operations, are not eligible here. That income would just be subtracted from the whole farm revenue. So you can't cover production in that way. You can cover some, and Clif talked about this, some products that you purchase for resale, but production contracts are not allowable. So, just one way to look at it in terms of having the conversation with farmers, a quick place to look is the difference between what their whole farm, what that revenue is and how much coverage they've got.
Great, thank you. Yeah, and then I was hoping maybe you could also talk about, I know that one of the requirements for applying for a loan for many farmers and ranchers is proof of crop insurance. So this product also creates an opportunity in that it allows people who hadn't had access to crop insurance before now not only can access crop insurance, but then have greater access to credit. Any other points?
That's right. We see that quite a bit. We actually see that making a big difference. It often makes a difference in terms of the collateralization of the loan and allows some of the collateral to be shifted from real property to the crop itself, instead of having to tie up land or other assets in the collateralization. Many years ago, I had a conversation with a banker talking about a farmer that I had been working with who was selling into a higher value, selling whole animals into a higher value meat market. And you know, the banker was just like, I just can't lend to him. It just doesn't make sense to me. It's not, if I had to get rid of it, I have to do other things. You know, it's just a whole series of issues. And I stopped him and said, if he had crop insurance on it, could you lend to him? And he said, and the banker said, yeah, absolutely, in a minute. And so that was one of the things that really pushed us to be more proactive on working on this type of policy, because it does open up those lending opportunities into into a whole new level of different kinds of operations.
I'm sorry to hear y'all last time. We're going to try our best to.
Sorry, folks, we lost Anna. She's muted right now.
Oh, sorry, it's my fault.
I'm on.
Yeah.
What happened to mine?
Oh yeah, no, we're having some technical difficulties here. Sorry, everybody. Thanks for your patience. Yeah, so the question I was wondering we could talk a little bit more about is the growth factor. Like, when have you seen that work well, and what have you seen?
Yeah, I've got a specific case I've seen. I've got a producer that grows mums. Has about 10,000 mums. He's got 2 acres of pumpkins. He had 200 acres of soybeans, 100 acres of sweet potatoes, and I'm trying to make sure I get all the acres right. This year, all right, his average was like $220,000. This year he added 200 acres of corn, field corn. He rented, because what happened was an old man died in the community, and so the land, people own the land, the landlords asked him did he want to lease their property, and he said yes. So he never planted field corn. So what I did was I took the they took the field corn, I did, and I come up with the T yield for the area, which in their area was 90 bushels to the acre, and I took the price that RMA has, which was what, 370, what it was, and come up with an acre of corn is worth $300. Multiply it times 200 acres, and then I come up with that's whatever it is, ever how many thousand, and then I looked at the percentage, and it was less than 35%, so he got to add all that on. So his annual revenue was $220 based on his 5 years, but for this year it went up to like $260 because he added that. He could go all the way up to that 35. But now keep in mind, agents, you need to work with your company close on this, because if you're looking the rules with RMA, they leave that strictly up to the company underwriter to make that decision. So it's not a blanket, you do 35, you go up 35. You need to work close with your company underwriter to make sure they understand what's going on and you document it well. And if they're leasing land, you may have to get a written document. You may not. It all depends on your underwriter. If you follow it, you agents know exactly what I'm talking about.
Awesome, thank you. Now, here's another question. I know that oh, sorry, I lost it. Can you both touched on a little bit about how this policy can be applied for beginning farmers. I know that there's separate reporting requirements there. Have you seen it work well with beginning farmers, or have you seen kind of crop insurance agents run into any difficulties when working with beginning farmers?
No, there's 2 things there. There's another little stipulation that we don't hit on a lot, but it has worked for one. It actually helped one producer I know this year obtain coverage. You've got 2 things involved here. You got one, if you've got 15, 14, 13, you can buy the insurance, where historically you couldn't. Historically, you had to have it 5 years. So yes, I know of at least 2 policyholders right now that they got coverage because they'd only been farming 3 years. All right. I got one in Arkansas right now. That's exactly the case. They're growing organic edamame, they're growing organic sweet potatoes, and they're also growing some other row crops. So they would not. They have grown 4 years. They had 14, 13, 12 for last year and 11. So they only had 4 years. They wouldn't have qualified. So yes, it qualified them. Then there's another stipulation that says if you had a break in your 5 years, let's say you've been growing for 8 years, but out of your last 5, which for this coming year is going to be 15, 14, 13, 12, and 11, 13 you got sick, had to go in the hospital, and you couldn't plant any crop before you were out because it knocked your 5-year continuity out. Now you can substitute that year. Now I'm not going to go through, I'd have to get the handbook. I'm not going to set year right off the top of my head and tell you how to substitute it, but I'm going to tell you you can do it because I've got a producer that's like that, which is a big benefit. If that producer couldn't get a loan, if they applied for their loan, but for some reason their loan wasn't approved, it's got to be something outside of their control. Now you also, with that being said, you need to work with the company underwriter on that, but just be aware that that is an available thing now. 3 years, and also if you got to break the continuity because of something outside the control of the farmer.
Awesome. Then I remembered my other question. In my research on this project, one thing I heard was that, oh, we're having a little bit of background noise, sorry. One of the interesting things about this policy is that it's available across the country, and it's available for all kinds of operations. And so there's and so rather than try to prescribe for every situation, RMA has some amount of discretion and some amount of flexibility into the policy. Is that, can you speak to kind of how that compares to other crop insurance?
Yes, I can.
That makes sense.
There's a lot more flexibility in this policy, and a lot of the agents have some heartburn over this because it throws a lot of weight back on the agent and the underwriter with the company. And we ask for it, though. We ask for greater flexibility. We want everything covered. With greater flexibility comes greater responsibility. So as an agent, yes, you have to make determinations on price. It's not written out for you like an actuarial document. So coming up with the price, you have to come up with that. You know, and for this new producer, you know, if they don't have it 3 years, you got to come up with the other 5 years. You got to do that. You've got to prove if somebody's in between, skipped a year, why they did it. So with this greater flexibility, yes, there is something's not written out, and it's 35% I was just talking about. The 35% increase is not just across the board. Yeah, we'll increase it 35%. You've got to document why there's an increase, and you've also got the underwriter with the company has complete authority, where with most USDA programs it's written out and everything's written in black and white. That's not the case with this policy in a lot of cases. I like it personally, but like I said, some producers, some agents are a little apprehensive about that.
Gotcha. Yeah, so maybe the follow-up question is, do you have any advice for crop insurance agents who are working through that getting to know the policy and kind of onboarding on it?
Yes, I do. Find out who the underwriter with your company is that has specialized in whole farm, and get their cell phone number and work very closely with them. Get their email, their cell phone number, and work real closely with the underwriter, because most companies has designated a couple underwriters to specialize in this new whole farm. If your company doesn't want anything to do with the whole farm, find your company that will. That's what I can say, because you need an underwriter, if you're going to be selling this policy, that understands it, that has worked with RMA to make sure they understand it, and also that will work with you, because this is a flexible policy.
Great. Scott, do you have anything to add to any of that?
I just would say on the other side that this is an opportunity to reach out to a wide range of farmers who may not have been in the system before, and so the opportunity to do that, that's a it's a whole set of new business that might be available, and that could be available depending on your area. And so I just would encourage people to, as Cliff has said before, it takes a little bit of time. So to get out and look at it early, and help people consider it and line it up, I think could really be helpful.
Great. Well, I'm not seeing any more questions come through, so unless maybe kind of like last call for questions. Okay. Well, thank you so much, Scott, and thank you, Cliff, and thanks everybody for signing in.
Thank you very much. Enjoyed it. Have a good day.
Pleasure.
Thank you.
Mm-hmm. Bye.
Bye.